The stock market is still higher from when Trump was elected. So when might we see a Trump put in the stock market? Joining us now, we want to bring in Drew Pettit. He's Citi's US equity strategist. Drew, let's just first start with the action that we've seen over the last 24 to 48 hours, and I guess going back long before then. But help us make sense of this downward movement that we are seeing across the major averages and how worried we should be at this point.
So I think the starting point is really, really important. We were at a point where the market was fully valued around 6,000, 6,100. So when I say fully valued, I don't want to talk about PE multiples and stuff like that, but just to really simply break it down, for the growth that analysts were expecting, you had to hit those numbers just to justify what we were trading at today. So when we introduce headwinds like tariffs, and our math is with these tariffs in place, you're probably taking about $3 off of 2025 earnings estimates, every 3 months. You start to see these really acute moves in markets. So you get defensive, you take some risk off the table, and that's exactly what we've been seeing in the past month.
Drew, so $3 off earnings every 3 months that these tariffs would be in place, right? I guess I know it's hard to predict, but what sort of base case do you guys have for now is how long you think the tariffs are going to be in place and therefore how much of a headwind they actually are to earnings this year?
The toughest question for everyone, I can give you a number, but I have no idea. And I think that's what gets a little bit messy here. Everyone always talks about uncertainty in markets. The future's never certain. Let's just start with that. But for us, it's just really, really hard to handicap. And we're sitting here digging through the data, digging through every headline, digging through every executive order. We don't really know. So when you don't have that confidence or even just some base case to really throw out there, you get these air pockets to some extent. And I think probably around 55, 5,600, we start balancing the risks a little bit better. But I really don't have a good answer for how long these can be in place.
Drew, I guess maybe another question here is what needs to happen in order for that bull market to more meaningfully kick back in? When we talk about the resilience here of earnings, whether or not that's going to be enough, what else do we need to see in order to regain some of that movement to the upside?
Yeah, so number one, we got to start moving past some of these macro concern stories. We're talking about consumer softness right now. How soft? We're talking about manufacturing. Are we going to get a resurgence? Okay, not quite sure yet. Interest rates, they've come down, but they're reacting to growth. What's the Fed going to do? Is inflation going to stay relatively benign or at least on that kind of lower trend, which is okay for equities? I think we got to clear some of those hurdles. And then tariffs, we just kind of need to know where the bottom or the end game is. I think we get past all of that, and a lot of the fundamental stories in the S&P are actually secular stories about efficiency and new technology. So let's just kind of check the box on a couple of these, headwinds for now, and I think we refocus on the secular stories.
Drew, you mentioned the Fed there. There's been some interesting movements as far as how markets are pricing rate cuts for this year, right? We've now moved to pricing in 3 rate cuts fully for 2025 for the first time. I mean, how are you seeing sort of the Fed path? Is 3 rate cuts, if we're getting it off growth concerns, actually good for the market, or would we want to see rate cuts come back off the table here as far as market pricing goes?
Yeah, right back to the setup leading into this. When you're fully valued, you need rates to be low and growth to be good. So you're seeing the reaction between the Citi Economic Surprise Index, which you brought up to kind of kick this segment off, Josh, and the market reaction. So Fed cuts because of weak economic data is not a good thing for markets anymore. If we were talking about this 2 months ago, Fed cuts against a resilient backdrop was good for markets.
All right, Drew, always love getting your insight here. Thanks so much for taking the time to join us.
Okay, thanks.